Let me ask you something. When was the last time you heard a major financial institution recommend silver as a core portfolio holding? When did a mainstream analyst last discuss the structural imbalances in the physical silver market on national television? The silence is deafening. And that silence tells us something important. I'm not here to sell you on silver. I'm here to walk you through what's actually happening in this market, the forces at play that rarely make headlines, and why the largest financial institutions have very specific reasons for keeping this conversation quiet. This isn't about conspiracy theories. This is about market structure, incentive systems, and the fundamental disconnect between paper contracts and physical reality. Over the next 25 minutes, we're going to examine the silver market with the same analytical rigor you'd apply to any serious investment decision. We'll look at supply dynamics, demand drivers, the role of derivatives, and the institutional behaviors that create opportunities for informed investors. By the end of this discussion, you'll understand why silver occupies a unique position in the financial system. You'll recognize the patterns that sophisticated investors watch for, and you'll have a framework for making rational decisions, whether you currently hold silver or you're considering your first position. This is about financial literacy, not financial promises. Let's begin. Silver is neither fish nor fowl, and this identity crisis is precisely what makes it interesting. Is it a precious metal, like gold, a store of value that thrives during currency debasement? Or is it an industrial commodity like copper, driven by manufacturing demand and economic cycles? The answer is both. And this dual nature creates pricing inefficiencies that don't exist in purely precious or purely industrial markets. Approximately 56% of silver demand comes from industrial applications. Solar panels, electronics, electric vehicles, medical equipment, water purification systems. These aren't discretionary uses. You cannot manufacture a modern smartphone without silver. You cannot build a solar panel without it. The remaining demand comes from investment, jewelry, and silverware. This portion responds to different drivers entirely: currency concerns, inflation expectations, geopolitical uncertainty. Here's why this matters. When economic growth accelerates, industrial demand rises. When economic uncertainty increases, investment demand rises. Silver is one of the few assets that can catch a bid from opposite economic scenarios simultaneously. But this dual nature also means silver gets categorized incorrectly by institutions. Commodity desks treat it like copper. Precious metals teams treat it like gold's smaller sibling. The result is analytical fragmentation and persistent mispricing. Most institutional investors don't have a proper framework for valuing an asset that functions as both industrial input and monetary hedge. So they underweight it, misunderstand it, or ignore it entirely. This creates opportunity for those who do understand it. Let's talk about where silver comes from, because this is where the story gets uncomfortable for certain market participants. Roughly 70% of mined silver comes as a byproduct of mining other metals: zinc, lead, copper, and gold. Only 30% comes from primary silver mines. What does this mean in practice? It means silver supply is largely inelastic to silver prices. If the price of silver doubles, a copper miner doesn't suddenly decide to extract more silver. They're mining for copper. The silver is incidental. Their production decisions are based on copper economics, not silver economics. This is fundamentally different from gold, where higher prices directly incentivize increased production. Now layer in the depletion problem. Silver ore grades have been declining for decades. Miners are extracting less silver per ton of ore than they did 20 or 30 years ago. New discoveries are rare and expensive to develop. The easy silver has already been found. Meanwhile, above-ground stockpiles are not what most people assume. Unlike gold, where essentially all the gold ever mined still exists in some form, silver gets consumed. Industrial uses destroy the metal. It gets dispersed in landfills, integrated into products, spread too thin to economically recover. The silver that governments once held in strategic reserves, most of it was sold off decades ago. The United States held over 2 billion ounces in 1960. Today, that stockpile is essentially gone. China, once a major exporter, became a net importer in 2007 and hasn't looked back. India's demand continues growing as the middle class expands. The structural deficit between mined supply and total demand has persisted for years, filled by above-ground stocks that are quietly diminishing. This isn't a crisis today or tomorrow. But it's a mathematical reality that compounds year after year. Eventually, the market will need to reconcile physical availability with paper promises. That reconciliation creates volatility, and volatility creates opportunity for the prepared. Now we arrive at the part of the story that makes institutional players uncomfortable. The silver market trades in two distinct realms: physical metal and paper contracts. The paper market, primarily COMEX futures and over-the-counter derivatives, dwarfs the physical market by an enormous margin. On any given day, the volume of silver traded on paper exceeds annual global mine production by multiples. Think about that carefully. More silver changes hands in derivative form in weeks than actually comes out of the ground in a year. This isn't inherently problematic. Derivatives serve legitimate functions: price discovery, hedging, liquidity provision. But the ratio of paper to physical creates a unique dynamic. Price is set in the derivatives market, but value is determined by physical availability. When these two diverge significantly, stress builds in the system. Large institutions have substantial short positions in silver futures. These aren't necessarily manipulative positions, though that debate continues. Many represent hedges for mining companies or industrial users, but the concentration of these short positions in a small number of entities creates structural vulnerability. What happens when a large portion of long contract holders demands physical delivery instead of cash settlement? The system isn't designed for that. The amount of physical silver backing these paper contracts is a fraction of the notional exposure. We saw glimpses of this tension in early 2021 when retail investors coordinated buying pressure on both futures and physical silver. Premiums on physical metals spiked, delivery delays extended, mints rationed production. The pressure subsided because most participants didn't maintain sustained buying. But the episode revealed the infrastructure's fragility. Here's the key insight. Institutions that are structurally short silver have no interest in drawing attention to supply constraints or the paper-physical disconnect. Their risk management depends on orderly, liquid markets, where most contracts settle in cash. Anything that drives awareness of physical scarcity or delivery stress runs counter to their positioning. This is why you don't see silver supply analysis on mainstream financial networks. This is why the conversation stays quiet. Not because of sinister conspiracy, but because of simple incentive alignment. Let's shift to the demand side, because something profound is happening in industrial consumption. The energy transition is real, regardless of your political views on climate policy. Governments worldwide are mandating increased renewable energy capacity. Corporations are setting net zero targets. This isn't ideology, it's capital allocation at massive scale. Silver is indispensable to this transition. A single solar panel contains approximately 20 grams of silver. Global solar installations are accelerating dramatically. China alone is installing solar capacity that requires hundreds of millions of ounces of silver annually. Electric vehicles use significantly more silver than internal combustion vehicles. The average EV contains 25 to 50 grams of silver across various components. As EV adoption grows, so does structural silver demand. 5G infrastructure, expanding globally, requires substantially more silver per installation than previous generation cellular networks. Medical applications continue growing. Silver's antimicrobial properties make it essential for wound dressings, medical devices, and hospital equipment. Water purification systems increasingly rely on silver technology, particularly in developing markets where clean water access is expanding. None of these demand sources are optional or discretionary. You cannot substitute your way out of them cost-effectively. Silver's unique electrical conductivity, thermal conductivity, and reflectivity properties make it irreplaceable in these applications. Research into alternatives continues, but replacing silver in most industrial applications would require significant performance trade-offs or cost increases that make substitution economically irrational at current silver prices. Here's what keeps supply analysts awake at night. Industrial demand alone could absorb most of global mine production within the next decade if current growth trajectories continue. That would leave investment demand, jewelry demand, and silverware demand competing for an increasingly limited available supply. Prices would need to rise substantially to either ration demand, incentivize recycling, or make substitution economically viable. This isn't speculation, this is arithmetic. Understanding why major banks avoid promoting silver requires understanding how they make money. Large financial institutions profit from several activities in precious metals: trading spreads, financing mining operations, providing hedging services, managing derivatives books, and facilitating flows between producers and consumers. These businesses require liquid, stable, predictable markets. Volatility is problematic when you're running large derivatives books with concentrated short positions. Sharp price moves create margin calls, force position adjustments, and generate losses on hedging operations. Institutional profit margins on precious metals trading are typically measured in basis points. They make money on volume and flow, not on directional price moves. Now consider what happens if they aggressively promote silver investment to retail clients. Increased retail buying creates upward price pressure. If institutions are structurally short for hedging purposes, they're fighting their own clients' orders. Rising prices squeeze their short hedges, forcing them to buy at higher levels to cover risk. Furthermore, if silver becomes a mainstream retail investment, it attracts speculative momentum and increased volatility. This makes risk management more expensive and reduces profit margins on derivatives operations. Compare this to their relationship with equity markets. Banks happily promote stock ownership because they profit from brokerage commissions, underwriting fees, and facilitating corporate finance activities. Rising stock prices help their corporate clients and generate more business opportunities. Their incentives align with promoting equity investment. With silver, the incentive structure is opposite. Many of their profitable activities work better when silver remains overlooked, undervalued, and stable. This doesn't mean they're actively suppressing prices through illegal manipulation. It simply means they have no business reason to draw attention to an asset class where increased demand would complicate their risk management and reduce their profitability. Silence is their optimal strategy. For individual investors, this institutional disinterest creates informational asymmetry. While institutions are analyzing silver supply dynamics internally for their trading and hedging operations, they're not sharing those insights broadly with retail clients. This gap between institutional knowledge and public awareness is where opportunity exists. Silver has exhibited distinct behavioral patterns across different market environments. Understanding these patterns helps calibrate expectations. During the 1970s, silver rose from roughly $1.50 per ounce to peak near $50 in early 1980. This wasn't primarily about industrial demand. It was about currency debasement, inflation fears, and the Hunt brothers' attempt to corner the market. The collapse that followed taught important lessons. Leverage destroys, parabolic moves end badly, market manipulation eventually fails. Silver returned to single digits within years. From 2000 to 2011, silver rose from approximately $4 to $49. This move coincided with quantitative easing, sovereign debt concerns, and a broad commodities supercycle. Gold was making new highs. Investors sought inflation hedges. Again, the move ended with a sharp correction. Silver fell back to the mid-teens and spent years consolidating. What do these historical episodes tell us? First, silver is capable of explosive moves when monetary conditions align with investment demand. The metal has beta to gold, but with higher volatility in both directions. Second, silver peaks are characterized by retail euphoria and speculative excess. When your neighbor is talking about silver, you're probably near a top, not a bottom. Third, sustainable silver bull markets require fundamental underpinnings. The 1970s had genuine inflation and dollar debasement. The 2000s had unprecedented monetary expansion and emerging market growth. Fourth, corrections in silver are brutal. This isn't an asset for weak hands or over-leveraged positions. 50% drawdowns have occurred multiple times. Patience and emotional discipline are non-negotiable. Currently, silver trades well below its 1980 high of $50 and well below its 2011 high of $49, despite 40-plus years of monetary expansion and currency creation. In inflation-adjusted terms, silver would need to exceed $150 to match the 1980 peak's real purchasing power. This doesn't mean silver will reach those levels. It simply means the metal has room to appreciate substantially without entering historically unprecedented territory. The question isn't whether silver can rise. History confirms it can. The question is whether current conditions support a sustained move and whether you're positioned to benefit when that move occurs. If you currently hold physical silver, your primary challenge is psychological, not analytical. The metal will test your patience. It will trade sideways for months or years while other assets appear to be leaving you behind. You'll question your decision. You'll consider selling to chase returns elsewhere. This is where most investors fail. They buy silver for the right reasons: portfolio diversification, inflation protection, monetary insurance. But they sell for the wrong reasons: boredom, impatience, fear of missing out on other opportunities. Your holding strategy should be grounded in why you bought silver in the first place. If you bought it as insurance against currency debasement or monetary system stress, then selling during calm periods makes no sense. You don't cancel your homeowner's insurance because your house hasn't burned down yet. If you bought it because you understand the supply-demand fundamentals, then short-term price weakness is irrelevant unless those fundamentals have changed. Have industrial demand drivers reversed? Has new supply flooded the market? If not, the thesis remains intact. Position sizing matters enormously. If silver represents 10% of your portfolio, price volatility is manageable. If it represents 50%, every correction will feel like a crisis. Proper allocation allows you to hold through volatility without panic. Consider your time horizon honestly. Silver is not a trading vehicle for most investors. Transaction costs, premiums on physical metal, and bid-ask spreads make frequent buying and selling unprofitable. This is a multi-year hold, minimum. If you need the capital within 1 or 2 years, silver is not the appropriate vehicle. For those holding physical metal, storage and security are ongoing concerns. Review your storage arrangements periodically. Verify insurance coverage. If you're holding substantial quantities at home, understand the risks. Some holders use a barbell approach: physical metal for long-term holdings, and more liquid vehicles like silver mining stocks or ETFs for positions they might trade around. This allows the physical stack to remain untouched while maintaining flexibility for tactical adjustments. Rebalancing discipline is critical but often neglected. If silver appreciates significantly and grows from 10% to 20% of your portfolio, taking some profit to restore balance isn't abandoning your thesis, it's risk management. Conversely, if silver declines and shrinks to 5% of your portfolio, adding to your position at lower prices maintains your intended allocation. Most investors do the opposite. They buy more after prices rise and freeze when prices fall. This emotional response destroys long-term returns. Finally, ignore the noise. Daily price movements are meaningless. Weekly forecasts are worthless. The analyst who was bullish yesterday will be bearish tomorrow. Social media creates echo chambers that amplify both fear and greed. Your thesis is either intact or it isn't. Price volatility doesn't change fundamentals. If you're considering your first silver investment, begin with education, not capital deployment. Understand what you're buying and why. Are you buying insurance, speculation, portfolio diversification? Each purpose requires different positioning. Insurance means small allocation, physical metal, long time horizon, no intention to trade. You're protecting against tail risk, currency crisis, banking system stress, inflation spiraling beyond control. Speculation means larger allocation, more liquid vehicles, active monitoring, willingness to exit if thesis breaks. You're betting on supply-demand imbalances, creating price appreciation. Diversification means moderate allocation as one component among many, rebalanced periodically, held through cycles. Clarify your purpose before you buy anything. Next, decide between physical metal and paper vehicles. Physical silver provides true ownership, no counterparty risk, and tangible insurance value. But it comes with premiums, storage costs, security concerns, and low liquidity. Paper vehicles like ETFs, mining stocks, or futures provide liquidity and ease of trading but introduce counterparty risk, management fees, and tracking error. For most investors starting out, a combination makes sense. Some physical metal for the insurance component, and some liquid vehicles for the investment component. If you're buying physical, understand premium structures. You'll pay above spot price when buying. You'll receive below spot when selling. The spread can range from 5 to 20% depending on product type and market conditions. Large bars carry lower premiums than coins. Generic rounds are cheaper than government-issued coins. These premiums are a transaction cost, not an investment. Don't rationalize high premiums by assuming silver will appreciate enough to make them irrelevant. Buy the lowest premium products that meet your needs. Regarding allocation, conventional wisdom suggests precious metals should represent 5 to 15% of a diversified portfolio, with silver comprising a subset of that allocation. If you hold no precious metals currently, starting with 2 to 5% in silver is reasonable. This is enough to matter if your thesis proves correct, but not enough to devastate your wealth if you're wrong. Avoid going all in on silver or any single asset. The investors who lost everything in precious metals weren't wrong about their thesis. They were overleveraged and forced to sell at the worst possible time. Timing is less important than consistency. Trying to buy at the exact bottom is futile. Dollar cost averaging, where you make regular small purchases over time, removes timing risk and emotional decision making. Set a schedule, set an amount, execute mechanically regardless of price. This approach ensures you buy more ounces when prices are low and fewer when prices are high, naturally optimizing your cost basis. Finally, separate your silver holdings from your tradable portfolio mentally. Once you've bought your physical metal, consider it gone. It's not money you can spend next month. It's not an asset you'll trade around. It's insurance that sits in a safe until the world changes in ways that make you grateful you bought it. This mental separation prevents panic selling during corrections. Let's be explicit about the errors that will undermine your success, because knowing what not to do is as important as knowing what to do. Silver's volatility makes leverage catastrophic. A 20% correction with 3.1 leverage wipes out 60% of your capital. Margin calls force you to sell at the worst possible time. Use no leverage. Own what you can afford to own outright. Silver is not lottery ticket. It's not going to make you wealthy next quarter. Approaching it with that mindset guarantees poor decisions, impatience, and eventual disappointment. Volatility is the price of admission. If you cannot psychologically tolerate 50% drawdowns, you shouldn't own silver. Selling after prices have fallen means you locked in losses and abandoned your position before potential recovery. When silver is making headlines, when everyone around you is talking about it, when prices are vertical, that's when risk is highest. The best buying opportunities come when nobody cares, when silver is boring, when you feel stupid for holding it. If silver appreciates and becomes a dominant portfolio position, you're overexposed. Take profits, rebalance, reduce concentration. The investors who rode gold from $400 to $1,900 and then back to $1,200 without selling weren't patient. They were negligent. Your position is worth nothing until you sell it. Paper wealth creates false confidence. If your thesis was that silver would reach a certain level, and it does, honor your plan and take profits. Don't keep moving the goalposts higher. The loudest voices in silver communities are often the least informed. People who promise imminent price explosions, guaranteed returns, or insider knowledge are selling you hope, not analysis. Do your own research. Trust your own thesis. Silver has opportunity cost. Capital allocated here cannot be allocated elsewhere. If you're holding silver while it stagnates and other assets appreciate substantially, that represents a real cost. This doesn't mean you should chase performance, but it means silver should be sized appropriately relative to other opportunities. Physical silver requires secure storage. Substantial holdings require insurance. Sales may trigger capital gains taxes, depending on jurisdiction. Ignoring these practical matters creates problems when you eventually sell or transfer holdings. Silver doesn't care about you. It's not loyal. It won't reward your faith. Develop emotional discipline to sell when your thesis breaks, even if you're at a loss. Holding a broken thesis because you cannot admit error is ego, not investing. Avoiding these mistakes won't guarantee success, but committing these mistakes virtually guarantees failure. Silver doesn't exist in a vacuum. Its price responds to broader macroeconomic forces that shape all asset markets. Understanding these forces helps calibrate realistic expectations. When central banks expand money supply aggressively and real interest rates are negative, hard assets like silver tend to appreciate. When central banks tighten policy and real rates rise, silver faces headwinds. Current monetary conditions are unusual. Despite years of inflation concerns, central banks expanded their balance sheets to unprecedented levels. Debt levels across developed economies are at peacetime records. The structural need for financial repression, keeping interest rates below inflation to erode real debt burdens, creates a favorable environment for hard assets over time. However, the path is never linear. Periods of tightening create volatility and corrections. Silver is priced in dollars globally. When the dollar strengthens, silver tends to weaken, and vice versa. Dollar strength is influenced by interest rate differentials, capital flows, geopolitical stability, and reserve currency demand. Long-term dollar debasement concerns support silver, but short-term dollar rallies create selling pressure. When investors believe inflation will erode purchasing power, they seek inflation hedges. Silver benefits from this rotation. When inflation fears subside, or when central banks convince markets they have inflation under control, investment demand softens. Actual inflation matters less than inflation expectations. During risk-on environments, silver often correlates with industrial commodities and equity markets. During risk-off events, it can behave like gold, attracting safe haven flows. This shifting correlation makes silver difficult to model, but creates opportunities during regime changes. Banking crises, sovereign defaults, trade wars, military conflicts. These events drive investors toward tangible assets. Silver participates in these moves, but with less intensity than gold. The current geopolitical environment is characterized by declining trust in institutions, rising nationalism, de-dollarization efforts by certain countries, and increasing concerns about financial system stability. These structural trends favor hard assets over the long term, even if short-term price action remains volatile. If you're convinced that monetary conditions favor hard assets, that supply constraints in silver are real, that industrial demand is structurally growing, and that institutional disinterest creates mispricing, then silver deserves a place in your portfolio. But let's be clear about what that means practically. It means a measured allocation, not an all-or-nothing bet. It means buying physical metal and putting it away, not trading in and out based on daily price movements. It means understanding that your thesis may take years to play out, and that patience is required. It means accepting volatility as normal, not traumatic. It means rebalancing when appropriate, not holding forever, regardless of circumstances. If you're skeptical, if the thesis doesn't resonate, if you have better opportunities elsewhere, then don't buy silver just because someone told you to. This isn't a recommendation, it's a framework for evaluation. The worst possible approach is buying silver because you fear missing out, without conviction in the underlying thesis. Those investors sell at the bottom and buy at the top, destroying wealth systematically. Your job is to understand the market structure, recognize the forces at play, assess the risk-reward ratio given your personal circumstances, and make an informed decision that aligns with your financial goals and risk tolerance. Silver is neither salvation nor speculation. It's a commodity with unique properties, unusual market dynamics, institutional behaviors that create informational asymmetries, and a role to play in diversified portfolios for investors who understand what they're buying. Big banks aren't actively conspiring to suppress silver prices through illegal manipulation, though that narrative is popular in certain communities. What's actually happening is simpler and more mundane. They have no incentive to draw attention to an asset class where increased retail participation complicates their risk management and reduces their profitability. They profit from quiet, stable, liquid markets where they can harvest spreads and manage flows efficiently. Retail enthusiasm creates volatility, delivery pressure, and directional risk, so they stay quiet. They don't analyze silver publicly, they don't recommend it to clients, they don't discuss supply constraints on earnings calls, This creates opportunity for independent investors who are willing to do the work themselves, not opportunity for guaranteed profits. Markets don't work that way. But opportunity to position yourself based on fundamentals that are underappreciated, to benefit from supply-demand imbalances that aren't priced in, and to hold an asset that provides diversification and insurance properties. The key is approaching this with discipline, not emotion, with realistic expectations, not fantasies of overnight wealth, with proper position sizing, not over-leveraged concentration, with patience, not panic. The investors who succeed in silver are the ones who buy quietly when nobody cares, hold through volatility without flinching, rebalance when appropriate to manage risk, and remain emotionally detached from daily price movements. They understand that wealth is built through compound decisions over long periods, not through single perfect trades. They recognize that protecting capital is as important as growing it. They know that what big banks don't say is often more informative than what they do say. If you take nothing else from this discussion, take this. The story of silver is not one of guaranteed returns or secret manipulation. It's a story of market structure, incentive misalignment, supply-demand fundamentals, and institutional behavior patterns that create inefficiencies. Your task is to evaluate whether those inefficiencies represent opportunity for someone in your circumstances, with your risk tolerance and your time horizon. Make that evaluation honestly, position accordingly. And then do the hardest thing in investing. Wait patiently while markets work through their processes, trusting your analysis more than your emotions. That discipline, more than any forecast or prediction, will determine whether silver becomes a valuable component of your financial strategy or an expensive lesson in the importance of knowing yourself before you invest. The market will tell its story in its own time. Your success depends on whether you're still there to benefit when it does.